Hi, this is Dan Collins coming to you live from Traders Expo New York. Joining me is Andy Waldock from Waldock Trading. We have been talking about Andy's work on the Commitment to Traders report, but you're also doing a lot of work right now on seasonality.
I am. Dan, what happened in my analysis of the COT report, as I started branching into seasonality, we started trying to figure out which comes first, the commercial move or the seasonal move, which precedes, so which one is leading. And without divulging the secrets of our work, we've definitely found a pattern that improves the accuracy of seasonal analysis and allows us, most importantly, to narrow the risk on a seasonal trade. As you know, most seasonal trades come, you get in this date and you get out that date and hold on tight in between. And we can't trade like that.
And I mean, I think it would add to your COT work, because obviously, especially when you're talking about ag markets, the numbers of the commercial traders versus the speculators depends on whether it's in the growing season, the planting season, and so, you know, I'm sure that the commercials have a higher number at certain points, so you should look at it, you know, with that seasonal tendency. Using that.
The other thing that we run into, and I'll revealing a little bit of it, is speculators tend to jump in ahead of the commercials. So the commercials who are executing according to their business plan have a much more disciplined approach, and the noise of the speculators can confuse the signal at times. But using in fact, we just did a slide in soybeans, as we're talking about the grain markets, that shows how the speculative position has changed over the last 10 years, and they've become these huge breakout traders. If you run the plot of their positions, they're all up here and they're all down here and nothing in the middle anymore. So by analyzing the commercial trader position in the middle, we get an idea for what value line prices may be in a given commodity.
Yeah, and I would guess that the commercial traders is a more static movement.
It is. It's more consistent. Well, and again, going back to the seasonality in trading, I've seen several seasonal reports where you can find 10 years that a commodity, you know, you can buy it on this date and sell it on this date, and over the last 10 years you would have made money, but there's no fundamental reason behind the seasonal move. It's not like grain trading where you have seasonal effects like getting the crop in the ground. And in today's day, what we've seen is that is the single largest variable. The one factor that farmers can't control, and the biggest factor in the grain markets, is getting the crop in the ground in the spring. Everything else can be managed. The crop can be harvested, the crop can be dried, but getting it in the ground is the real issue.
Yeah, and planting intentions, and that's a big risk there, depending how wet how cold the winter was, how wet the spring was.
Well, and thankfully, the shutdown ended in time for us to get the planting intentions was last week in the USDA reports. So things are resuming, and we are getting back to normal, and I expect the markets to as well.
Okay. Now, there's some risk in the seasonal trades too, because I know there was a big fund that kind of blew up in natural gas, and I think they were making a seasonal play, and probably too leverage of a seasonal play, and you have the seasonal go against seasons.
When, as you know, I mean, you've seen this before. When seasonal trades fail, or the market, you know, it's usually because of a fundamental disruption in the market that really changes things. In your case, what you're talking about, I do believe, was a situation of over-leveraging. I think the key to our seasonal program that makes it unique is that we limit risk and provide a stop-loss order before the trade is even entered. So people know exactly what's on the table before a trade is taken. And anyone that's been trading for any length of time knows that you must trade with stop losses in the market. Always protect your downside. And
I think that's a lot of spread traders, they put on more because there's less risk. But we've seen that in the grain markets the last few years, where there are huge moves in the spreads, bigger than like outright moves in other years, and that's where people can really get hurt.
That's very true. And to keep it simple, when I do my seasonal analysis, A, it's based on a fundamental reason. B, I filter it through the commitment to traders, and C, I do it in the front month futures contract. So we always have liquidity. We always have a fundamental reason for what we're doing, and once again, we know what our risk is before the trade is placed.
Yeah. And I mean, isn't the key that there are seasonal tendencies, but some people treat them as rules, and they think it's a repeatable pattern. You earn money this way all the time, and it's not always that easy.
In the introductory seminar that I just did, a gentleman was insisting on the 9% return from the S&P as good as he'll ever need, year in, year out. And I congratulate him on that and wish him well.
If you can average that over 50 years, he's probably right.
Again, I can't start here and there and hold on tight in between. I need more parameters than that.
All right, Andy, thanks for joining us. Thanks. This has been Dan Collins with Andy Waldock from Traders Expo New York.